Hello, everybody. Good morning and good afternoon or good evening. Welcome here to the weekly for trade, the weekly webinar. The main topic of today's webinar will be Federal Reserve meeting, which will be held tomorrow, and the NFP report, which will be on Friday. So I need to start off with a risk disclaimer before we move any further. So at Fortrade, you trade contracts for different CFDs, and I would want to highlight three key points here. Trading CFDs and other leverage products carries a high level of risk to your capital as prices may move rapidly against you. You can lose all, but not more than the balance on your trading account. CFDs may not be suitable for all clients, therefore ensure you understand the risks and seek the independent advice if needed. You can find the full risk disclosure statement on the ForTrade website. So let's go now and go back to our presentation. And in this webinar, here we will talk more about the FOMC meetings and about its importance, NFP report and its importance, and afterwards a technical analysis. So aside from major geopolitical risks that should continue to dominate headlines next week, actually even this week also, including potential standoff between US and North Korea over the latest nuclear provocation, currency markets in the first week of May will likely be dominated by economic event-driven moves in the US dollar. The two most important US-based economy events occurring this week will center around Wednesday's May FOMC meeting and Friday's US jobs report for April. Through markets are not expecting any major policy change from the Fed, so soon after the March rate hike, there will be a clear focus on any indications surrounding both the potential trajectory of rate increases going forward, as well as Fed's unclear stated intentions to shrink its massive balance sheet. If the reduction of this balance sheet is a primary topic of discussion at the FOMC meeting and on the Fed statement, the dollar could receive a significant boost. Friday then brings the eagerly anticipated US jobs data for April, including the monthly non-farm payroll report. The job data will especially be critical in a view of disappointing US GDP number that came out on Friday, which showed an annual growth rate of just 0.7% in the first quarter against consensus expectations of 1.2%. Though this disappointment was essentially shrugging off the market Friday, it could have some impact on Fed discussions going forward. With the long-awaited White House tax plan failing to adjust markets this week, investors will be turning their attention on these US job data and Federal Reserve meeting as well. The Federal Reserve meeting is two-day monetary policy setting meeting on Tuesday with an announcement due to the following day, actually tomorrow. So let's go from the start. What is the FOMC? The Federal Open Market Committee. This is the monetary policy body of the Federal Reserve System. The Federal Open Market Committee consists of 12 members. The FOMC holds 8 regularly scheduled meetings per year. As these meetings, the committee reviews economic and financial conditions, determines the appropriate stance of the monetary policy, and assesses the risks to its long-term goals of price stability and sustainable economic growth. So why are the FOMC meetings so important for the markets? In the meeting, FOMC determines near-term monetary policy. Immediately after the meeting, Federal Reserve announced this decision, and because the Federal Reserve determines interest rate policy at this FOMC meeting, it is very important. Speculations often occurs weeks in advance. about what will happen with interest rates following the meeting. The minutes of these meetings are released 3 weeks after the gathering. The expected change in rate, if it's any, is often priced into the markets prior the announcement, which can cause drastic market actions should the announcement be different from what was expected. Interest rate cuts can stimulate economy, but at the same time reduce the value of the currency. Through open market operation, adjusting the discount rate and setting bank reserve requirements, the Federal Reserve possesses the tools necessary to increase or to decrease the money supplies. The Fed's Board of Governors is in charge of setting the discount rate and reserve requirements, while the FOMC is especially in charge of open market operations, which entails the buying and selling of government securities. For example, to tighten money supply, decreasing the amount of money available in the banking system, the Fed sells government securities. Minutes from the Federal Reserve Open Market Committee, previous from the March meeting, highlighted the key aspects of the committee's thinking, so including the committee's intent to reduce its balance sheet gradually over the time. Review now, let's us review the what actually happened on the previous meeting. In March, Federal Reserve increased its key interest rate by 0.25% to a 0.75 up to 1% range. It struck a familiar tone in its statement, pointing out the interest rate increases will be gradual during the 2017 and maintained in its view of 3 rate hikes, which the remaining 2 rate hikes expected later this year. The FOMC indicate the pace of the economic recovery warranted gradual tightening. Chair Janet Yellen hinted also the Fed would tolerate inflation even above 2% target, as 2% is not a ceiling. On the other side, on March meeting, Federal Reserve officials said that shedding of the $4.5 trillion in bonds the central bank is holding on its balance sheet will begin this year. Officials at the last Fed meeting noted that the Fed likely is on a faster pace with rate hikes ahead and signaled just 2 further rate increases are likely for 2017, a total 3 of rates. With the Federal Reserve projects to rise interest rates at least twice more this year, focus has turned to when Fed will begin winding down its $4.2 trillion balance sheet. What can be expected from this meeting? Economists expect the central bank to leave interest rates unchanged, with many expecting the central bank to next lift interest rates in June. Wednesday announcement will not be followed by a press conference with Chair Janet Yellen, and investors are likely to analyze the statement for clues on the Fed's assessment of inflation, labor market slack, and risks to the economic outlook. This week is unlikely that FOMC to provide the market with additional details on changes to balance sheet policies. Sorry for this, pardon. Markets also await remarks from Fed Vice Chair Stanley Fischer and Chicago's Fed President Charles Evans, both voting members of the monetary policy setting FOMC, who are scheduled to speak on Friday. Chair Janet Yellen also is scheduled to speak on Friday. So 2 days after, this was for Federal Reserve meeting, and after, just 2 days after the Fed meeting on Friday, May the 5th, in US will be published the NFP report. As published after the Fed meeting, its importance and influence on the market can be this time a bit reduced. Nevertheless, this is still the most important employment report in US and as so having debate, of course. The Fed officials, along with the wider markets, will nevertheless watching the US jobs report closely on Friday. So, what is NFP? Non-farm payrolls report is the release of data on US jobs growth over the previous month, and it is published by the Bureau of Labor Statistics, usually on the first Friday of the month. So it is undoubtedly the most eagerly awaited monthly data by world markets. The headline number in the report gives the number of jobs, obviously excluding farms, that the US economy has gained or lost in the previous month. A more important number for the market, however, is the difference between the actual change and the consensus of estimates by analysts and economists published in advance. Market reaction will depend on whether the published figure is above or below the consensus, and by how much, of course. As well as new data, the publication also includes the revisions of the two previous months. So revisions are more substantial in either direction, calling into action the wisdom of any significant market reaction based on a single preliminary figure. So, what can we expect from this week's report? After the previous month's highly disappointing 98,000 jobs added in March against the 175K expected, the current forecast for April's gain in jobs is around 195K. The actual outcome will be critical in its ability to redeem March data weakness in the eye of Federal Reserve. The US unemployment rate conveys the percentage of people registered as unemployment in the United States. So on Friday, in the same time when NFP is going to be published, also will be published the unemployment rate. Those two reports are always published at the same time during the first Friday on the month. So now we explained what actually is the unemployment rate. So change in non-farm payrolls generally moves the market upon release. The unemployment rate serves as the most popular snapshot figure for the current labor conditions in the US. As the report on the total unemployment rate comes out at the same time as non-farm payrolls, mixed financial market reactions may be recorded. The market usually first react to NFP data, and soon after they can get on corrective trajectory to reflect unemployment rate data. So what can we expect from this week report? Economists expect hiring to rebound, with the US economy creating 193,000 jobs in April, following the 98,000 jobs the previous month. The unemployment rate is expected to tick up to 4.6% from 4.5% previously, while wage growth is estimated to have improved. Economists forecast that average hourly earnings rose 0.3% from March, but climbed 2.7% on year, unchanged from the previous base. So don't forget that usually on Friday, on morning, the trading volumes are usually slim during the European markets session on the day of the release, as a majority of investors just awaits the afternoon release time. So let's a little bit focus more now on the Federal Monetary Policy and EFP. Markets used to be concerned about the likely future direction of interest rates. Usually, a disappointing figure might foretell a cut to boost growth, while if job growth was higher than expected, analysts might look for the Federal Reserve to hike rates. to cool an overheating economy, which is actually nowadays the issue. Nowadays, the Federal Reserves are on the trajectory of increasement interest rate. In December 2016, in a view of realized and expected labor market conditions in inflation, the Federal Open Market Committee decided to rise Federal Reserve market interest rates to 0.75% from 0.50%. And on previous meeting on March, it again increased interest rate further up to 1%. So altogether, now I think that we should go and try to look in more detail what can we expect on our live charts. Okay. So let's look now. Here is a dollar index chart. This is a daily chart, and just to see how we made this. Okay, sorry, this is not so much good. We use this Fibonacci trend from here, and this was, the start was the April 2016, and the top is here on the beginning of 2017. This was a strong uptrend, so we use it for creating these Fibonacci levels. Let's go back on a 4-hour chart. Okay, let's keep it in daily. So we have here the descending channel. Sorry, it's not completely channel, it's forming almost a triangle. So after this peak, which was actually occurred at the beginning of the year, of January this year, dollar index is with oscillation in a mild downtrend. So 3 peaks here, and now we are here around 38.2% of Fibonacci level. So it's just oscillating here. So as tomorrow we will have this Federal Reserve meeting, and on Friday the publication of NFP. Depending of the result of NFP, as well of tomorrow decision of Federal Reserve, we can expect that the dollar index can increase further up to reach the upper line of this channel, or even further up here, up to the 23.6 level, which is $101. And after that, if break this line, it can go even further up and reach the previous height from the beginning of the year. But if something else happened, if disappointing NFP results, or from some reason, because we are pretty much sure the Federal Reserve will not increase further up interest rate, but maybe the statement will be bearish, will be more dovish. And if that happen, then we can see the dollar index go a little bit down and even reach this 98.22. Of course, because this is a daily chart, this is the movements during the whole week and even the next week. Okay, let's go now on the euro dollar. Of euro dollar here, and of course, depending here, we have a small recovery of the double down of a euro dollar, and now it's euro dollar, it's recovering a bit. And depending, of course, again on the decision of Federal Reserve, more this statement than the decision by itself, or an NFP results on Friday, we can expect that euro dollar can reach maybe in the next week 1.083 level, or to rebound from the moving average. And this moving averages we are using here are exponential, and this green line is moving average with 200, and this is 100. This is dark blue navy, and orange is moving average with period of 20. So actually it's now here, it's touching moving average of 200 price currently. And if something happened, if value of dollar decreased, during the next week it can go even further. This currency pair value can go even further up to the 1.08 that was already said, or in vice versa. If dollar in value increase in value, this currency pair it can go even further down. But just keep in mind, and here this is a channel, this is ascending channel for quite a while, and according to technical analysis, is more likely just to this uptrend to be continued in next few days. And now let's go on the gold chart. This is again 1-day chart. Again, we are here using moving average, exponential moving averages of 200, 100, and 20 periods of 20. So here we already, the price of gold reached the upline of this channel and rebounded. So we have also, we are using here Fibonacci levels, and it rebounded like 5 days ago from the 74.6 level, and now slowly going down. And depending, of course, again on the value of the dollar, it can reach down and fall to the 1254 point maybe 50, or otherwise if dollar starts decreasing to again start rising and reach these levels of 74.6%. This is 1293.65. So be very cautious about all these fundamentals. This is important. These fundamentals can influence the markets very strongly. And keep in mind that no one can exactly predict what can happen. So make your stop losses and try to trade very carefully. Okay, so this is from our presentation. Okay, if you have now, it will be the good time if you have any questions. No, nothing. Okay, wait a little bit wide. Okay, nothing. Maybe next time. Okay, we reach here the end of our time. I want to wish you all the very best luck in your trading and have a great week, of course. Talk to you soon. Bye now.